By popular demand, we're here to do more deep dives into companies. Today's is Best Buy. Please watch the whole video. We're going to show you live. This is literally without any prep. Mo and I, Mo's here. Say hi, Mo.
Hey guys, what's up?
Mo did a video a while ago on Intel, a deep dive. It was very, very popular. People really appreciated it. We're doing a deeper dive into companies. Now remember, this isn't the be all and end all in terms of we're done after this, but this is a great start and it doesn't take long at all. We're going to do this video together in 15 or 20 minutes, and we're going to show you how much information you can get about a company in 15 or 20 minutes. So Best Buy, here we go. Let's pull up our software. And I really, really encourage that if you're one of the smart people who has our software to pull it up along the way. So Best Buy is at $74 a share. It had a peak of 142 this year, which is down almost 50%. Let's see the 10-year chart. Actually, it's all-time highs. Interesting. Okay. All right. So Best Buy, big dividend, 4.3%, pays out $700 million. So last year's free cash flow was $970. The 5-year average was $2 billion. So based on the 5-year average, I'm very comfortable with this dividend. So you have to make sure that this 1-year free cash flow is hopefully a fluke on the downside and they're going to get back to normal stages. Because if it stays down at 970, I have a hard time believing they're going to keep that dividend going. That's a big chunk of their dividend, of their free cash flow. Gross margin, 22%. Profit margin, last 5 years of 3.7. Now, guys, what are the... Oh, wow. Look at this return on invested capital, 26.6%.
Wow, that's awesome.
From a high-level perspective, Mo, what are Best Buy's issues? The biggest, most glaring one?
Just being a store.
They're a retail, exactly.
Yeah, that's it.
But I like retail because I feel like there's been a lot of beaten down retail because people are so anti-retail. Mm-hmm. We buy a lot from Amazon.
Yeah.
But when I buy electronics, I really try to go to Best Buy or the Apple store if I go there because I know Best Buy will be there to help me with the tech side.
Or if I don't buy something and I'm curious to see something, I will go there, and that's the only place you can
Best
go
Buy
and
will
try it
price
out.
match.
Yeah, they will price match. Yeah.
So for me, one of the things I'm going to look at is how are they growing their online sales? Because it's very easy. I've ordered computers from them. It's literally like, yeah, just come pick it up. It's ready.
Their online presence is very, very good. They just need to get people to the website. If they get people to the website, they're selling.
Yeah, it's a great process, and hopefully they really help their customer service out a lot. All right, so let's go to the 8 pillars real quick. All right. So we have almost all 8 pillars. The difference is we have $8 billion increase in revenue, which led to a $1.2 billion increase in free cash flow. Sorry, net income, but a decrease in free cash flow of $400 million over the last 5 years. So before I go further, I want to go check out the cash flow statement. So 5 years ago, you did 1.39. Last year, 972. Here's the big reason. Big change in working capital. All right. In previous years, it was positive or slightly negative. And this is, I guess, something I'm seeing a lot in retail companies these days. Probably had to do with their inventory levels, is my guess, over the COVID year, things like that. So keep that in mind. I think it's a one-time occurrence because if you look at their past, they had one big year back in 2013, and then it dropped big time along the way. So I don't think it's a permanent fixture on their free cash flow.
Looking at that free cash flow and then looking at that dividend, I mean, that's a lot of dividend that they're paying based on the past 10 years, outside of just their COVID numbers. COVID numbers, they're fine. That $700 million is fine. But outside of that, that's a lot.
Yeah, you're right. So the question is, are these COVID numbers a fluke? Well, remember one thing, but here, look at this, Mo. Mm-hmm. The 2020 ended in 04. They're this full year, mm-hmm. $2.7 billion in free cash flow. COVID had just started then. That was 2 months into, that was a month and a half into COVID.
True. Yeah.
So are they just getting better as a company overall in terms of their online presence?
Or did they sell that much in that 2-month period?
They were closed.
No, they were doing everything.
March and April?
Online sales and
were they really?
Pickup.
Well, let's look.
I will say this, guys. I think that they were the first ones to really be the renegades for this store pickup. Like you order it online, you go do curbside pickup. They were one of the very first to do it and do it very effectively.
Here's what I'll say. Let's go look at their income statement. Quarterly income statement. Go back to that quarter ending. Mm-hmm. It's their lowest quarter in the last 10 quarters.
Wow.
So I don't think so.
Okay, there you go. Guys,
I don't think so.
This is the purpose of these deep dives. Go and figure it out.
They went from 15 billion down to, well, that's also included Christmas. But yeah, this is the revenue from that quarter we're talking about.
Yep. Okay.
So I'm not as concerned about that, but great point to bring up, Mo.
Yeah. These are the things you guys just go look for. Doesn't hurt to look.
All right, let's go look at analyst estimates real quick. So analyst estimates, They're expecting a 37% drop in EPS, but then growth from there. And remember, 31 analysts here, only 14 that far in the future. And these are not the only 31 analysts out there looking at Best Buy. It's our data feed. So they have big jump in EPS, probably driven a lot by the fact they're buying back shares. Because look at their revenue. The revenue growth, not there. They're expected to do a drop of 11% and then grow low single digits from here. So this can be very useful for our stock analyzer tool. So if you're new to our channel, I'm Paul, that's Mo. We're value investors. Our goal is to use our 8-pillar process to look at the quantitative aspects of a business, and then from there, decide what aspects of the company we want to look further into. Our goal is to find situations where the market perception of the company is worse than the actual reality, where price and value are disconnected this way. If we find that and we do more research, we like the company, we buy the stock. That is our main goal. It's very simple, but it's not easy. So we're doing this deeper dive to show how else we look at the company. So, Mo, I'm going to go to the annual report. And guys, it's here on our main page of our site. Go right here to the annual reports button. Click it. Takes you right to the SEC website. But Mo, why don't you talk about some of the things you read about people's comments on our good friend Best Buy?
Yeah. So the first thing that I looked for was their forward financial guidance from their last quarterly report. So our current full year 2023 planning assumptions for comparable sales decline in the range of about 11%. So that's something that you want to pay attention to right off the rip. As it relates specifically to Q3, full year 2023, we anticipate our comparable sales will decline slightly more than 12.1% decline we reported in the second quarter. So this is something that is kind of worrisome right off the bat.
Well, but it is expected in those analyst estimates if you see that.
It is.
And this is the comparable store sales from their 10K. From 2022, they had a 10% increase. 2021 was a 9.7, and 2020 was 2.1. That was even with part of COVID being in there. Mm-hmm. So you're right. They're going to decrease their, but guess what? Amazon did the same thing. Look at Amazon's retail sales. Yeah. They've dropped as well.
True. I'm also interested to see what stores they're closing. Are they going to close low-performing stores, increase the product in high-demand stores, something like that?
Yeah. So another thing I'm going to look at, and we'll look at that next, Mo. This is a gross profit as a percentage of revenue. 22.5, 22.4, 23. So very consistent. One of the things we've seen during big surges is people jacking up their prices, exaggerating that profit margin, but people take it as a one-time. I don't think that's the case here. Now, look at their EPS, diluted earnings per share. Down here, 575, 684, 984. And again, that will drop, but the point is it's still increasing as they buy back shares. So I don't even know what the heck Pacific Sales are and Yardbird. Do you know what these are?
No.
In 2020, they started the year with 1,000. They ended the year in 2020 with 1,009 stores. Finished 2021 with 991. Finished 2022. Remember, it's not done with 2022. It's the April of 2022 with 984. So they are closing locations. They opened 2 new Best Buys and closed 20 in that 1 year of 2022. That's pretty big. Revenue mix. You can see a revenue mix. Computing and mobile phones, down slightly. All right. But comparable sales. You can see these right here. Now let's go look at online. So I'm going to look at online sales.
So one question that I do have going forward is a lot of these bigger companies, these tech companies, Google, Apple, et cetera, they're going to this more business to consumer model, direct. I worry that they're going to eliminate the middleman, and that's a further decline.
Maybe.
Yeah, that's just a thought.
Listen, look at Nike. Nike's starting to sell a lot more consumer direct, right?
Yeah.
And it's Foot Locker a lot. Mm-hmm. But and everybody thinks that they're leaving Foot Locker. They're not. They're not,
right.
Correct.
They're just going to reduce it. It's not over. It's not
and that's definitely a concern long term for these companies. But
something to factor in and think about.
So maybe I'm being idealistic. My comment is, as a consumer, do I want to have to go to every individual store to learn about every single product as opposed to going to one store and saying, hey, can you compare these for me? Mm-hmm. There's still going to be a value to somebody guiding you along the way. Right. Like when I went recently to go buy those glasses that had the earphones, that had the speakers,
Ray-Bans.
There were several, not Ray-Bans, it was like Bose and all that stuff, but I bought different ones.
Oh, okay.
There were several options out there, and it's nice to hear somebody say, well, we're seeing this, we're seeing that, etc. And I like the fact that Best Buy salespeople are not salespeopeople. They're there to help you.
Yeah, exactly.
Right? So by the way, look at comparable online sales. 2020 had a 17% increase. 2021, 144% increase. Oof. 2022, 12% decrease. But keep in mind, even with a decrease, it's still well above 2020. So they got people to buy online in 2021, and they kept a lot of those people. Now, I still like going to the store sometimes, a lot of times, but I might be a weirdo about that. But I really like going to the store to just walk around, see things, and get advice from people. So who knows what's going to happen there? But I do like to see that they're increasing it. Total online revenue. Look at this, Mo. Total online revenue is a percentage of total segment revenue. It was 19% in 2020. It's 34% now.
Yeah, that makes me happy.
Yeah, so they're going to keep growing that. That's a good thing.
Very good thing.
That's a very good thing. Now, there's a debate we just had when we took a little break here about consumer behavior, because a lot of the pros and cons of these that Mo's looking for are just saying, hey, it all depends where consumers go. And that's a very, very valid point. But guys, you got to remember, like, I do believe retail is changing, absolutely, but I don't believe retail is going away forever. I do believe that we will have a very different world in retail 10 years from now from today. But does that mean it all has to go away? Not necessarily.
Doesn't need to die.
Doesn't need to die necessarily. Look at newspapers. Newspapers started to die, but guess what? They transitioned to online. And some of these newspapers are doing better online than they were as print. Less costs, less things like that. Economies change. But now, is it possible we have a metaverse someday where you're able to touch and feel out stuff? Sure, of course you can. I mean, that's very possible. But look at Amazon. They're building all these huge distribution centers. Best Buy's goal should be every single store is a distribution center.
Correct.
That's how they have to look at it. We're just a bunch of distribution centers with people inside that can come help you. Yep. That is the goal. Yep. And hopefully Best Buy is able to win by helping out with something with customer support. Because I've heard people, when they complain about Amazon, one of the major things is you can't get a hold of anybody. They hide the phone number for Amazon on Amazon. Right. With Best Buy, you can call in, you can go in the store and get help from somebody.
You can have the Geek Squad come to your house if you really want to. Amazon doesn't have that. Or they hire a third party to come to you.
Yeah, and there's benefits to both. Yep. But for me, Amazon is the place I go to for things I don't need to think about.
Guaranteed item that you
like, okay, I need to buy batteries. I'm not going to go to Best Buy to buy batteries. I need to buy hair product. Okay, great. But when I'm going to buy a TV, if I'm going to buy a computer, personally, I will go to Best Buy. I like feeling it, like touching it, like seeing it, feel all that stuff. And that's a big factor.
Especially headphones. Headphones, I want to hear them first.
Yeah.
That's my big thing.
That's definitely a big benefit to all that.
Yeah.
So from here, guys, let's use a stock analyzer tool. So the stock analyzer tool is something we created out of demand because I was using an Excel sheet to build a model. This is a model on the future because every investment's the present value of all future cash flow, right? But we don't know the future. So our goal is to make assumptions about the future and then have the stock analyzer tool tell us based on those assumptions what price we should pay for the company. Very simple. Now, I want you to make sure you rewind this part over and over because I'm going to do a little bit deeper into these assumptions. I'm also going to ask Mo for his assumptions as well. So Mo, first line, we're doing a 10-year analysis. First line is revenue growth. The last 10 years, it did 2.1% a year, 4.4 over the last 5, and 0.9% in the last year. What's a low, middle, and high revenue assumption that you're going to put in?
How about -2.5?
Okay.
0 and 2.
Okay.
I think 2 high. I think 2.5 high side would be too high.
I think 2.5 downside is low, but I like that we do that.
So when I do my lows, I really like to stress this thing.
Okay.
See how low I can get this thing. And even if it comes in the money, I'm like, okay, now I can go from here.
Great. All right. Profit margin. 2.9 in the last 10 years, 3.7 in the last 5, 4.3 in the last 1 year.
2, 2.5, 3.
So I think that's too low.
Too low?
And the reason being is they're getting better and better with online sales. It's taking up a bigger part of the thing. It's going to take less people to do it, less overhead, et cetera.
Good point.
I think myself personally, I think 2.75, 3.25, and 3.75.
Okay.
I think that's reasonable.
Are you going to do the same for free cash flow?
I think so. What do you think?
I think so.
And the reason being, guys, is free cash flow and earnings should be very similar to each other over long periods of time. Now, PE, Mo, low, middle, and high based on these growth rates.
8, 10, and 12?
Yeah, I think so. Maybe you can go a little bit lower than 8, but I think 8, 10, and 12 is fine. Maybe even 8, 11, and 14, but I think 8, 10, and 12 is good.
Okay.
And the same with free cash flow, right?
Yep.
Now, finally, desired annual return. Guys, the higher your desired return, the lower the price to pay for the stock. So if you put in 100%, your stock price is going to go very far down because you have to pay a very little amount of money to get 100% return on the company. And this is your annualized desired return for the next 10 years that you want. So Mo, if we can get 9 or 10% from a long-term ETF, and we've made very conservative assumptions here, what do you want in desired annual return for the low side?
12.5.
Okay, I agree.
Make the juice worth the squeeze.
And what about the middle?
14.
Okay, and the high?
16.
Okay, so my personal opinion would have been 12.5, 15, and 17.5, but I don't think this is anything other than what's your opinion on this.
Yeah.
And I think you're being conservative anyhow. So the stock is currently at $74. When I hit the analyze button here, guys, what's going to happen is 6 numbers are going to pop up. 3 based on a multiple of earnings and 3 based on a multiple of free cash flow. If it's all green, it does not mean go out and buy. It means go verify your accuracy of these numbers. If it's partial green but close, go verify the accuracy of those numbers. How do you do that? Go do your own research. This deep dive was still deeper than we always do, but you can find out more information. Maybe, we were looking at a company like Sleep Number recently, and tomorrow we have a call. Mo and I are getting together, and we're going to call investor relations. We have 2 very specific questions we want investor relations to answer for us about Sleep Number. But most importantly, guys, join this community. You get so much with this, but one of the things you get is thousands of people in here every single day talking about investing. You can go look up Best Buy in the chat, go to the chat, start the conversation, have people engaged in Best Buy, and talk about what they're looking at. Because investing is hard, but it's so much easier when a lot of people are doing the research with you. It's a very lonely road to be a value investor, so you found it, and please use the community of thousands and thousands of people in here ready to talk about it every single day. Less than a cup of coffee per day. You're going to pay less than $1 per day for the software, and everythingmoney.com or patreon.com/everythingmoney for our international users. Analyze button. Boom. 42 low side, 72 high side, 57 middle. And look, it's currently on my watch list at $55, which I feel comfortable with. Guys, add it to your watch list. It'll notify you on the app and email and the software. Thank you very much. If you like this video, I really insist you watch the next video on our margin of safety so you can understand more about how we view margin of safety. Thank you very much for your time, and please subscribe to our channel.